Silver just broke through a critical resistance level that has held for over a decade. And what happened next sent shockwaves through the entire precious metals market. If you're not paying attention right now, you could miss the biggest wealth transfer opportunity in a generation. This is not a drill. In the last 72 hours, silver has surged past $32 per ounce. Trading volumes exploded. Exchange inventories are draining at an alarming rate. And the smart money? They've been quietly accumulating for months, while retail investors remain distracted by meme stocks and crypto speculation. What I'm about to share with you isn't hype. It's not speculation. It's cold, hard data from COMEX, the Shanghai Futures Exchange, and the physical dealer market. The numbers don't lie, and right now they're screaming one thing: the silver market is fundamentally broken. Whether you own silver, are thinking about buying silver, or have never considered precious metals before, the next 10 minutes could change how you view your entire financial future. Let's break down exactly what just happened and why it matters so much. Here are the facts. Silver prices jumped over 4% in a single trading session. This move pushed silver to its highest level since early 2012. The breakout occurred on massive volume, nearly 3 times the average daily turnover on COMEX futures. The catalyst? A perfect storm of factors converging simultaneously. Industrial demand from the solar sector hit an all-time high. Central bank policy uncertainty sent investors scrambling for safe haven assets. Perhaps most importantly, registered COMEX inventories dropped below 140 million ounces. That inventory number is critical. Just 18 months ago, COMEX held over 300 million ounces of registered silver. We've seen a 50% decline in deliverable metal. Meanwhile, open interest on futures contracts has remained stubbornly high. This creates a dangerous imbalance. On the Shanghai Futures Exchange, silver inventories tell an even more dramatic story. Chinese warehouses are being drained at a pace not seen since 2020. Industrial users are hoarding physical metal, concerned about future supply disruptions. Delivery times have extended from days to weeks. The spot premium for physical silver bars and coins has widened to levels that indicate genuine tightness. 1-ounce American silver eagles now carry premiums exceeding $8 over spot. Generic rounds command $4 premiums. Dealers report inventory selling out within hours of restocking. Let me explain why these developments matter for every investor. The silver market operates on a delicate balance between paper trading and physical reality. For years, paper markets have suppressed price discovery through leveraged futures contracts. That system is showing unprecedented strain. For physical silver holders, rising premiums mean your metal is worth significantly more than spot price suggests. The gap between paper and physical pricing represents real value. If you bought silver at $25 with a $3 premium, your actual cost basis reflects true market conditions. For paper market traders, the current environment presents both opportunity and danger. As inventories decline, the risk of delivery failures increases. Short positions face unlimited theoretical losses if a genuine squeeze develops. We've seen this dynamic before in other commodities. For new investors considering entering the market, timing becomes crucial. Waiting for pullbacks is reasonable, but waiting too long risks missing a parabolic move entirely. Silver is notorious for explosive upside moves that happen faster than most can react. The industrial implications extend beyond investment markets. Manufacturers who need silver for solar panels, electronics, and medical devices now face supply uncertainty. Some are reportedly stockpiling 6 months of inventory rather than their typical 30-day supply. This behavior creates additional demand pressure. The divergence between physical and paper silver has never been more pronounced. On COMEX, you can buy a silver futures contract representing 5,000 ounces for a margin deposit of around $8,000. But try taking delivery and the reality becomes complicated. Registered inventory available for immediate delivery represents just a fraction of total warehouse holdings. Much of the silver in COMEX vaults is classified as eligible, meaning it meets purity standards, but isn't available for delivery. Owners are sitting tight, unwilling to sell at current prices. Physical dealers tell a consistent story across the country. Wholesale supplies are tight. Delivery from mints is delayed. Customer demand has surged, particularly from first-time buyers who remember 2020 shortages. Many shops limit purchases to prevent inventory depletion. The premium differential creates arbitrage opportunities for sophisticated players. Buying paper silver while selling physical creates profits when premiums are elevated. But this trade requires physical inventory, which is increasingly difficult to source. The arbitrage is closing as physical metal disappears. Critics argue that premiums simply reflect temporary supply chain issues and will normalize. Supporters counter that premiums represent the true market price when paper manipulation is removed from the equation. History will determine which interpretation proves correct. China's role in the silver market cannot be overstated. The country consumes over 30% of global silver production annually. Solar panel manufacturing alone accounts for 150 million ounces of Chinese demand. Electric vehicle production adds millions more. The Shanghai Futures Exchange has become an increasingly important price discovery mechanism. Unlike COMEX, Shanghai operates with genuine physical settlement expectations. When Chinese buyers want silver, they take delivery. This creates authentic price pressure that Western paper markets struggle to contain. India remains the world's largest silver jewelry consumer. The subcontinent imported over 250 million ounces last year, a record amount. Indian buyers are notoriously price sensitive, typically buying heavily during dips. Current prices have temporarily slowed purchases, but underlying demand remains robust. European investment demand has surged amid economic uncertainty. German investors in particular have increased silver purchases dramatically. The removal of VAT exemptions on silver coins years ago initially dampened demand, but current prices have reignited interest despite the tax burden. Mexico, the world's largest silver producer, faces its own challenges. Mining costs have increased, labor disputes disrupt production. Environmental regulations tighten. The country's output has plateaued despite higher prices, limiting global supply growth precisely when demand is accelerating. Major financial institutions are adjusting their silver outlooks. Bank of America recently raised their price target, citing supply deficits extending through 2026. JP Morgan, historically accused of suppressing silver prices, has reportedly built a substantial physical position in COMEX warehouses. Independent analysts paint an even more bullish picture. Keith Neumeyer, CEO of First Majestic Silver, maintains his long-standing prediction of triple-digit silver prices. He argues that the gold-to-silver ratio, currently around 80-1, must contract toward its historical average of 50-1. Hedge fund positioning shows interesting dynamics. Managed money remains net long, but positioning is not extreme by historical standards. This suggests room for additional speculative buying if momentum continues. When hedge funds pile in, moves become amplified and volatile. Retail sentiment, measured through social media and dealer reports, has turned increasingly bullish. The silver stacking community on Reddit and other platforms continues growing. New participants are entering the physical market, creating grassroots demand that institutional players often underestimate. Bearish arguments focus on recession risks, reducing industrial demand, potential Federal Reserve rate hikes strengthening the dollar, and historical patterns of failed breakouts. These concerns merit attention. However, current supply-demand fundamentals differ from previous failed rallies. Bull case scenario, silver breaks convincingly above $35, triggering momentum buying and short covering. Industrial users panic buy inventory. COMEX delivery requests surge, exposing paper market leverage. Price rapidly approaches $50 within 6 months, potentially exceeding the 2011 highs. In this scenario, mining stocks explode higher. Physical premiums initially spike, then gradually normalize as supply catches up with demand. Silver becomes a mainstream investment topic, attracting new capital from investors who previously ignored precious metals entirely. Neutral case scenario, silver consolidates between $28 and $35 for several months. The market digests recent gains. Some weak hands sell, frustrated by choppy price action. Strong hands accumulate during dips. The next major move waits for a fresh catalyst. Risk case scenario, global recession triggers widespread asset liquidation. Silver initially falls alongside stocks before recovering. Paper market manipulation temporarily succeeds in capping prices. Premiums collapse as distressed sellers flood the physical market. Patient buyers accumulate cheaply. Regardless of which scenario unfolds, the long-term trajectory appears increasingly favorable for silver. Structural supply deficits, expanding industrial applications, and monetary uncertainty create a compelling fundamental backdrop. The question isn't whether silver rises, but when and how fast. Let me be absolutely clear about what's happening. We are witnessing a potential generational shift in the silver market. The convergence of industrial demand, investment buying, and supply constraints creates conditions not seen in decades. Ignoring this situation could prove extremely costly. The window for accumulating physical silver at current prices may be closing. Every day that passes sees more metal leaving exchanges and entering strong hands. When supply genuinely tightens, price moves become violent and unpredictable. Waiting for the perfect entry often means missing the move entirely. I'm not telling you to mortgage your house or take irresponsible risks, but I am suggesting that silver deserves a place in every diversified portfolio. The risk-reward profile at current levels appears asymmetric. Downside seems limited, while upside potential remains substantial. If you found this analysis valuable, smash that subscribe button right now. Turn on notifications so you don't miss critical updates on the silver market. The situation is evolving rapidly, and I'm committed to keeping you informed as developments unfold. Drop a comment below telling me your silver price prediction for year-end. Are you bullish, bearish, or somewhere in between? Do you prefer physical metal or mining stocks? I read every comment, and your insights help shape future content. Hit that like button to support the channel and help this important information reach more investors. Share this video with anyone who needs to understand what's happening in precious metals. Together, we can spread awareness about this crucial market. The silver market is waking up. The question is, will you be positioned to benefit, or will you watch from the sidelines as history unfolds? The choice is yours. But remember, in markets, those who hesitate often lose. Stay informed, stay prepared, and I'll see you in the next video. I'll see you.